Welcome back to this very special edition of Indianomics, coming to you from the SBI head office, where we have two stalwarts of the banking industry, Mr. O.P. Bhatt and Mr. MV Nair, discussing the key problems facing the Indian banking sector. Well, Mr. Bhatt, capital. To finance this kind of growth, an 8 to 10% growth that you spoke about, are the capital norms that are available to you enough? You have some hybrid capital, perpetual bonds. Is this really enough?
Capital is going to be an issue. Capital is going to be an issue for the public sector banks. Easily, rough estimates are that in the next 3 to 5 years, depending upon how the growth momentum pans out, and depending upon what other activities the banking sector gets into, you would have seen that over time, the definition of banking in terms of products and services getting expanded. And also banks are owning companies which are in the financial sector, not necessarily bank. For example, insurance, which takes humongous amounts of capital. So in the next 3 to 5 years, the capital requirements of the public sector banks could be anywhere between 1 lakh crores to 2 lakh crores. So it depends upon how these various factors pan out. Now, this amount of capital should be available within the system. I don't see that it is such a large sum of money as is not available in the system. But if the public sector bank's ownership, in our case it is 55% minimum mandated with the government by way of an act, for the rest of the public sector it is 51%, then it would mean that the government would have to shell out about 50,000 crores. Now again, if you look at it, in 3 to 5 year period to shell out 50,000 crores, or if it is 2 lakh crores to shell out 1 lakh crores, at one level should not be too difficult for the government. The difficulty would be of priorities. The government is deficit financing. It will continue for some more time.
Do you think willy-nilly, maybe in the next 2 years, Mr. Nair, the government and the general Indian public will have to prepare for a banking sector that is controlled maybe 33% by the government and not 51%? Is that such a big danger in the first place if 33% is with the government?
Yeah, I think you raised the point which is well debated for over a period of time, and the government stand has been very clear that we would like to retain 51%. It's a stand that the government may have to take, and then they have been consistently mentioning that we will capitalize our public sector banks. But having said that, I would like to focus on two issues. One is globally, after the downturn, the return on equity is expected to come down. It's already come down. So the blowback of the profit is also going to come down. The challenges are much more. While you have an economy which is going to grow exponentially, where the capital need is high. Second, the return on equity itself coming down is going to have an issue.
You expect that to hit Indian banks? Because the Indian banking, the results so far are quite
so far has been very good. But there's a general observation is, this could be a trend, and then we should prepare for the trend. And the whole point is we should prepare for the trend. But having said that, the public sector banks, there are many banks. There are well-performing banks, there are weak banks. The normal approach has been you capitalize the weak bank. I would only like to make a point that capitalize the healthier banks so that the healthier banks can actually meet the requirement of the economy and not only position within the country globally.
But speaking about this return of equity, that leads to the other issue, which Mr. Bhatt, you raised very prominently in the BanCon, the issue of infrastructure funding, which has become the prominent guzzler or recipient of capital, recipient of bank loans in the past 6 months or so, and that exacerbating your asset liability mismatch. You said if this, if there is a crisis in 4 or 5 years, this could well be because of infrastructure loans. Is that a situation that is worrisome?
At the moment, if you look at the banks outstanding on account of infrastructure loans, it is not worrisome. Just to give you some figures, say from State Bank of India, our exposure to infrastructure is about 10% of our loan book. And our CASA ratio is about 40% plus. Now, this CASA ratio itself, the CASA outside itself, covers our infrastructure many times over, right? So, if you look at it that way, there is not an issue now. The point I was making is that infrastructure loans are long-term loans, 15 years average. It could be even 20 years. There are two issues which banks have. One is that traditionally a commercial lender is not so much in project loans. Even in India, we had specialized institutions like ICICI or IDBI or IFCI. And the second thing is that, again, traditionally, banks deposits rarely go beyond 5 years. I mean, you may have a rate for 5 year plus, but you don't get any money there because there are alternate avenues. Usually it is in the 1 to 3 years range. And today, bulk of it is actually 1 year range because of the way the rates have been moving. So there is definitely an asset liability mismatch. Now today the mismatch is not causing any strain. As I said that, infrastructure loans are only about 10%, CASA is about 40%. For the industry, it could be maybe infrastructure loans are 7 or 8%, CASA maybe 35%. But in both cases, it is, within it. But we have been saying, everybody has been saying for a long time that India's infrastructure requirements are huge. $500 billion in the next 3-5 years. We are also saying that if the economy has to grow at 8% plus, then infrastructure should not become a bottleneck. So that infrastructure has to be encouraged at all costs. Now, even today, the projected mismatch between the infrastructure requirements of 500 billion and the available money from all sources, debt and equity, is about 350 billion. Now, these are all estimates, yes. So it could be wrong, but broadly it gives you the sense. So $150 billion gap is there. The banking industry already, stretched and will get more stretched. Plus, there is a gap there. So the point I was making is that we have to do all these things. And if you have to do all these things, and we are looking at these two strains, one is the gap and the other is that banking industry strictly may not be the appropriate vehicle to take this forward. So now is the time both to do thinking and put up the enablements, both for instruments which will mop up medium to long-term funds, and for institutions which will A, help in the mopping up the fund, and B, also intermediate.
So are you all preparing with some retail bonds? We know that one is waiting at the SBI board. But will this become an industry trend, retail bonds, so that you all raise longer term money?
Now, today, if we raise bond, we may have to say 10-year bond has been raised about 8.80%. Now, after, keep the SLR and CRR, the pricing, even if you keep only 50 basis point profit, even then it's 12%. Now, 12% for a infrastructure lending is a high price.
It's not viable.
It's not viable. We may need to figure out how to bring it down. What it means is we may need fiscal benefit for raising the bonds, one side, and second side SLR and CRR may have to be exempted. If you do that, then our own internal calculations says it can be brought down by 3 percentage points. 9% is a good price. So this is what the challenges of infrastructure lending is, and then we may have to face it. Right?
I can see that you're using the BankCon and the CNBC platform to make your pre-budget demand. But on one issue, neither the government nor the banking sector can be forgiven. After 60 years of independence, a large part of India is unbanked. That question after this break.